Our argument right now is not because silver has nipped out its highs, but because of momentum factors, spread relationship factors to gold, that silver is about to launch a handful of month, couple quarter surge out of this now 50-year range into a new price reality. And I think at minimum that will be 100 plus. More likely it's going to be 200. And I think much of that will occur in the next 6 months. And there is one primary signal metric that we're watching for that. And it's not price. It's not momentum of price. Silver's already in a bull market. There's no issue about it. The issue is, when does it go 8 on the upside?
Michaeloliver, known for his momentum-based market analysis, has become one of the strongest voices, suggesting that gold and silver are on the verge of a historic repricing, potentially taking silver to $200 per ounce and gold to $10,000 per ounce. He argues that the underlying technical and structural forces in both metals have reached a critical inflection point, where years of paper manipulation and suppressed volatility can no longer contain the true directional momentum. Oliver emphasizes that this coming move will not be a gradual rally, but a vertical repricing event triggered by the breakdown of confidence in debt-based assets and fiat currencies. The signals he tracks long-term momentum structures and relative performance trends are now flashing in ways that have only appeared at major historical turning points, such as in the 1970s and early 2000s. He explains that silver's setup is especially powerful because of how deeply it has been undervalued for so long. The gold-to-silver ratio, which recently hovered near historic highs above 80-1, reflects an imbalance that cannot persist in a world shifting back toward tangible value. When monetary panic and industrial scarcity converge, he says, silver's reversion to fair value will not stop at $50. It will overshoot massively, with $200 being a conservative target once investors and institutions realize how little physical silver exists relative to demand. Silver's explosive potential lies in its dual identity. It's both a monetary metal and a critical industrial resource, giving it the leverage to outperform gold when capital begins flowing back into real assets. Like, subscribe, and stay prepared for more real market insights. The truth they won't tell you on mainstream finance is what could protect your wealth tomorrow.
Silver has only this past week nipped out the high of that 50-year range. We're talking solely price here, an idiot chart. Okay. I call it idiot because if you go back and you factor in the degradation of the real buying power of the US dollar in 1980 to the present, or from even 2011 to the present, if silver were matching that degradation, it'd be at $200 plus right now. Okay. Something looking like the gold chart, which is compensated for those ongoing degradations in the money unit. But silver hasn't done that. In fact, I can show you a copper chart. If you go back to 1970s and 80s, it had a range in price that prevailed between 1970, 80, 90, and into 2000, like 2005, where it was stuck in a horizontal range. And in 2005, I think it was, it broke out of that range and quintupled in a half. No, excuse me, that's erroneous. It quadrupled in a matter of 6 to 9 months. It took out a multi-decade range and quadrupled almost in price, and then lived since then, since 2006-07, in another major sideways range, but a new price reality compared to the prior range. Silver's still just only now emerging from a prior 50-year price reality. So in a sense, silver is much lagged to many other assets. I could show you a lead chart. Our argument right now is not because silver has nipped out its highs, but because of momentum factors, spread relationship factors to gold, that silver is about to launch a handful of month, couple quarter surge out of this now 50-year range into a new price reality. And I think at minimum that will be 100 plus. More likely it's going to be 200. And I think much of that will occur in the next 6 months. And there is one primary signal metric that we're watching for that. And it's not price. It's not momentum of price. Silver's already in a bull market. There's no issue about it. The issue is, when does it go 8 on the upside? And when we went back and examined the final months of the surge that you see there in 79 to 80, where you went from like $10 to 50 in the final 5-6 months, boom, most of that was like 5 or 6 months in a couple of year bull trend. And you go back to 2010, where you see that jolt right there. Yeah, right there, where you see the jolt upward. From there to that high, it was about 20 something dollars to 50. So it about tripled in about 5 to 6 months. It had been going up for years already, so it was no issue. Silver was already a bull, but what caused it to suddenly go ape, to go vertical, and do it all in a handful of months? The spread relationship to gold was the signal indicator, not the dynamics of silver or its momentum trend, but the momentum and the dynamics of the spread between silver and gold. Right now, that spread is postured early this month to the present below structural levels. Well, you can see that pretty good there.
Yeah, that's the silver to gold ratio, by the
way.
Yeah,
we're going back to 2020 in particular. You had a big surge there, and that was in that surge when silver in the first half of 2020 into 2021. You're going back to 2011. Yeah, so that surge right there, that's the one we're looking at. We came up out of the hole there, and in 2020 to early 2021, silver vastly outperformed gold. But then over the past few years, even though silver has been rising during that time, and so has gold, the spread has deteriorated. Okay. We've recently, since April, that spread has shot back up again strongly. You get much above the recent highs, and you're going to break out on various metrics of that spread, which say you're coming out of here. Now, your trend line, we don't plot. We have different trend lines. But anyway, what I'm arguing is that this surge that we've just seen in silver is now pressing at levels on the momentum of the spread and the spread itself that say you go any further and you're going into launch mode again. Same sort of behavior occurred at those prior pivot points where silver went from up to dramatically up. And when you looked at those original charts I showed you, realize that silver has not done it for 50 years. Many other commodities have had prior ranges that prevailed for decades and blown out of them, but silver hasn't. Anyway, I think silver's about to do a catch up, and we know if you've been around in markets long enough that markets make mistakes. When you get bubble tops in the stock market and they collapse later on, the prior bulls have been buried. Look back and say, "Gee, I guess it was excessive. I should have gotten out." And when it goes down, it usually overcompensates for its prior upside excess. The same is true with markets that have been depressed for too long. They remain depressed. People dismiss them. They say, "There's nothing going on there. Just forget about it." They ignore it. And yet certain realities have occurred in fundamentals and so forth, and in the underlying degradation of the money unit, for example, which is something you have to compensate. All those factors build up, and finally the market says, "Oops, I made a mistake." And it comes roaring out of the hole, sort of the opposite of a bubble top breaking. It compensates for the error. I think silver is on the verge of compensating for the error. And I do not think it's going to trend up to a new price reality over the span of 2 years. I think it's largely going to get there in a couple of quarters and then live in the new price reality. And I think that reality is going to be somewhere, wouldn't surprise me, 200 even.
Gold, on the other hand, stands to become the cornerstone of a new financial order. Oliver believes that the breakdown of confidence in sovereign debt, particularly in Western economies, drowning in deficits, will force a repricing of gold to reflect its true monetary weight. At $10,000 per ounce, gold would merely be catching up to the scale of global liquidity expansion that has occurred over the past 2 decades. He points out that central banks have been quietly preparing for this transition, hoarding record amounts of physical gold while the public remains focused on stock markets and digital assets, but a reset of global balance sheets to account for years of monetary distortion. Oliver's analysis also highlights the psychological shift already underway among investors and institutions. He notes that each financial shock, from inflation spikes to banking instability, has pushed more capital toward gold and silver, but what comes next will be far more decisive. Once the momentum breaks free from the suppressive grip of paper markets, investors rush to gain exposure. The result, he predicts, will be an unprecedented transfer of wealth from financial assets into hard money. Gold's climb to $10,000 and silver's surge to $200 are not wild predictions. They are mathematical outcomes of a system forced to reconcile with its own imbalances.
Gold is 4 times where it was at the bear low. Its prior bull markets of the last 50 years, 2 of them are 8-fold, okay? You haven't even seen it yet. Imagine if silver catches up, which we think it will, but in a thunderbolt. So not only does gold have the potential just to replicate the 2 prior bulls, which I think it will vastly outpace, by the way, ultimately, silver will catch up, and that'll be an enormous move. Even if silver, like if you go back 50 years and look at silver versus gold spread and ask yourself, what's the highest reading that silver had versus gold as a percent scale? And right now we're at 1.2% price of gold. In the last 50 years, it's 20 of those 50 years, it's been at 2% or higher. If we even just went to 2% or higher, that's almost a doubling of the current valuation of silver to get back to what's a norm over the last 50 years. If you then go back and look at bull market years in silver versus gold, silver and gold, 79 to 80, for example, 2010-11, that spread was up to 3.5% or even 6.5% back in 1980, but well over 3%. Now, if we went to 3%, that would be a tripling in the current value of silver to gold. You do the math. If gold went to 8,500, which is to say nothing but replicating what it's done twice before, and silver went to 2% of that, silver would be $160.
Mm-hmm.
If silver went to 3% of that, you get the point. Okay. Silver has a major catch up to do, not only in relative performance to gold, which it's going to do, but in net price. And I think it will be a very compressed situation.
And you made mention of the fact that we were looking at the spot price versus the futures price.
We use December silver. That's all. And it's
gotcha.
Yeah.
So here's what I've got charted up here. I've got the spot price divided by the futures price, and you can see spot is what 6% higher, just about.
We've had that exhibit lately that's occurred, and I think those things are usually temporary, and even if it abates so that the spot comes back toward the futures price, and people say, oh well, we had a fire going there where we had no supply of silver bullion in London, so we had to fly it over, et cetera, et cetera. But cooling off that little fire doesn't change the fundamental. The fundamentals are, we don't analyze that, but we know about it.
Gotcha.
For 5 years in a row, we've had demand exceeding supply, new production every year. Now we're coming up from a very low reading in the spikes over the last couple of years. You see very low compared to the others. And only now are we getting back to the sort of what you'd call normal spike. Okay. Imagine you go even higher. But anyway, that can abate very quickly because that differential can change simply by moving silver from point A to point B and therefore cooling off the pressure that's on the LBMA right now and so forth. And that doesn't alter the trend reality that I'm talking. It's far bigger and not so spotty as this is. But that's just an indication that we do have tightness.
Right. So I want to take a look at another correlation here. This is silver and oil. Pull it up here. So we've got silver. Okay, we've got silver in yellow, oil in blue, and you'll notice they pretty much track each other fairly reliably. However, recently, over the last several months,
oil is
splitting.
Oil tracks very well, not gold and silver, but tracks the Bloomberg Commodity Index. And there's times when, for example, you could take from 2015 bear low in gold to 2020, when it went from 1,050 up over 2,000. Remember that move, okay? We peaked in 2020 and went sideways for a couple of years, okay? Went from 1,050 to 2,000. Same time, the Bloomberg Commodity Index continued down for those 5 years, and oil was under pressure for those 5. And oil is now one of the weaker components in the Bloomberg Commodity Index. For example, right now, spot oil is like $58 or spot futures, November contract. And we've got a major upside momentum breakout. Momentum, I'm talking, not price. But if you get back over $68 this quarter, watch out, you're going to go. But we're 58, so it's got to earn it. Meanwhile, the Bloomberg Commodity Index is right now 105.5. You get much over 106.5 on a monthly close, and it's going to move up. That's what you got. Bloomberg. Yeah, you can see those are monthlies. I can tell. You keep pushing up to the same level over and over. You get up to 108 plus and so forth. But a monthly close above 106.52 during this year will break out over annual momentum. It's similar to the price chart, but you'll break out over the ceiling. And you keep probing up there like you want to do it. But so far it hasn't done it. And one of the drags on the Bloomberg lately has been recent weakness in oil, which I don't think will continue, but it has been weak. But surely you could look at gold over the last months or beginning of this year and then look at oil. They're not in sync at all. Oil's been weakening, gold going vertical, same with silver. In fact, silver's up more year to date than gold is. Most people don't know that. They think silver's the dog, but it's asserted itself pretty strongly, especially since April, May. It turned up
60 plus
sharply.
percent, right? 65, 66%.
I think it's up more to gold. I know that on a percent now. It's still got a lot of catching up to do to get back to normal levels, like 2% of the price of an ounce of gold. But it has been strengthening sharply this year.
In the years ahead, the unfolding transformation in gold and silver markets is expected to follow a highly volatile yet ultimately explosive path. As liquidity tightens and market confidence erodes, each pullback will only serve to build greater pressure beneath the surface, preparing for a rapid vertical breakout once momentum fully shifts. When that moment arrives, the move could unfold with breathtaking speed, leaving late entrants unable to secure meaningful positions. This phase could usher in a new reality where both metals detach from traditional market behavior entirely, moving independently of central bank policy or economic forecasts. Silver, with its smaller supply base and dual industrial role, may outperform dramatically, amplifying both gains and volatility as demand overwhelms available stock. Gold, meanwhile, could stabilize at levels once thought unimaginable, serving as the anchor for a new era of monetary credibility. By the time the cycle reaches its climax, the world may look back on this period as the definitive turning point, the moment when real assets reclaimed their rightful place at the center of global finance. Thanks for watching.